We have the threat of world violence and wars going into the weekend. So what could go wrong? Before we get into what drove the markets lower today, in my video last week, I predicted the markets would move higher based on the bottom dynamics. Link to that video in the pinned comments below. Well, here you can see that I was correct for 2 days, Monday and Tuesday. You can see that things really went higher and then just collapsed. Now, why did they collapse? Well, they collapsed because the Consumer Price Index, or CPI, came in hotter than expected on Wednesday. And then on Thursday, the Producer Price Index, or PPI, came out softer than expected. And as you can see, the markets moved higher. But now on Friday, the markets sold off, as you can see here, with the fear of a potential attack on Israel. Let's first focus on the CPI and the PPI and which one we should believe. The CPI is very much a lagging indicator and looks back at what consumers faced in the rearview mirror, while the Producer Price Index is more of a leading indicator because it reports the prices consumers will likely pay going forward. The fact that it came in softer than expected indicates a potential future softening of the CPI. Here's what Cathie Wood had to say about inflation. I value and trust her view because she takes a holistic and novel approach to economic metrics, much like we do here at Invest Smarter with our market metrics.
On to monetary policy. So as we've been presenting, this chart, M2 and versus CPI inflation. So the green line is CPI inflation. The purple line is money growth. And we, as you can see, we've pushed it forward because money leads inflation. Milton Friedman told us that from the University of Chicago. Money is always behind the inflation rates, and how quickly it works is variable. And so you can see on this chart, the left-hand side, that scale is the CPI, and you can see we're around 3%, and we've been stuck there for a little while now. Now, this is much better than what people feared in 2021, when they thought, okay, this kind of money growth means we are going to see inflation like we saw in the 70s, in the high single digits for years. So it's not high single digits, it's low single digits. But look at what money growth is suggesting will happen during the next few years. It could go, and we think it will go, negative. And one of the reasons it will is rent. The stickiness of the CPI has to do more with rent than anything else. And it's a huge lagging indicator in the CPI, the way it's calculated. If you use some of the real-time indicators of rents around the nation, some of those are already flashing red. They're going down. And we think that's going to get, it depends on your point of view, whether you're a landlord or a renter. From the renter's point of view, it's going to get even better because there's so much supply coming into the system. Private equity and private credit was reaching for yield during the many years of near zero interest rates we had. And they really started in 08, 09. So near zero interest rates for 13, 14 years. And so they wanted to juice up their yields. They invested in multifamily dwellings, apartment houses, and leveraged those up. And they earned a pretty nice yield. Rents have been much better than Treasury yields, especially when they're leveraged up. And because that worked for so long, there is now a lot of supply hitting the system. You have to go back to the days in the 70s when real estate was much more of a tax shelter than it is today. It was a pure play tax shelter in the 70s. You have to go back to then to see as many multifamily units coming on the market in the next 2 years, about 1 million. And so that's going to drive rents down. And we think that will drive the CPI inflation rate down. You can see in 2014 to 20, money supply, the inflation rate was below the money supply for the most part. And we think that will, well, it'll have to go negative to prove the same this time around, but we think that will happen. The one other thing I will say about this chart and about money supply generally is many people say, well, we've never seen the money supply go to 27%. So, inflation is probably much more baked in the cake. Well, if you go back to, and maybe in the next month, we'll show you that chart. If you do go back to World War II and the Great Depression, money growth rates did get up into the 20s. In the Depression, we were in a liquidity trap. So people were so scared they weren't spending, and it was ineffective. And in World War II, the money printing was to finance the war. And that war lasted a long time, much longer than COVID did. And so the rapid money growth rates were much more sustained. And yet when money growth came down, inflation came down very dramatically after World War II as well. And we ended in the low single digits. So okay, the next chart takes us to what consumers are thinking about inflation now. So the University of Michigan does a consumer sentiment survey and one of the measures is 1 year inflation expectations. And you can see that the purple line here is the University of Michigan. The green line is the Fed's survey of consumer expectations. So both of them now have dropped from the 5.5% to 6.5% range to a little below 3%. Now, what's important about that? The Fed is looking for 2% inflation. You can see here, going back to 2013, that this metric, even though inflation dropped below 2%, this measure rarely gets below 2%, and it's already got a 2 handle. And if we're right with rent and so forth, this measure will continue to come down. Now, there is something that's a bit of a wrench in the works right now, and that's gasoline prices. The oil price has bumped back up. It will probably hit this metric. It did not hit it in the last measure, which was interesting. The last measure ticked down, as you can see in the purple line there, and that was, I believe, that was a late March number. So gasoline prices have been going up, but for some reason, maybe it's egg prices, some food prices are coming down. The consumer is expecting less inflation during the next year. It'll probably move up a bit because of gasoline prices, and I know that's going to be a worry that the equity markets will focus on. But we think, as we showed you in the previous chart, that the trend is down, and if we're right, it'll go negative. This yield curve chart is one reason we believe, or another reason we believe that will be the case. So money supply growth is one reason. The yield curve is the 10-year Treasury yield minus the 2-year Treasury yield. And usually the longer-term Treasury yields are higher than the shorter-term ones. Longer time frame, more risk, and so forth. More risk that inflation will be a worry. As you can see, however, the 10-year is still below the 2-year yield. And what that usually means is the bond market is seeing something to suggest that nominal GDP will be lower than expected. Nominal GDP includes both unit growth and inflation. So it sees one or both of those being lower than expected and lower than we're seeing now. And what that means is, either a harder landing in the economy. Let's just say as companies lose pricing power, they start and their unit growth is weak. They probably will be laying people off. They have refrained from doing so, even though the economy has been slowing because it was so hard to get labor, especially during COVID. We think that's changing. The unemployment rate has hooked up. The unemployment rate did come out today. We'll talk about that a little bit more in the economic section. But it's still below 4%. We think the trigger above 4% will be because companies are losing pricing power and they are willing to lay more people off now. The other reason for an inverted yield curve is much lower than expected inflation. So either recession, lower than expected inflation. And I think the big surprise for the Fed has been inflation has come down in a way it did not expect. And unit growth has remained stronger for longer, although there are conflicting metrics on that score. I've mentioned in the nose the difference between GDP and GDI, and so they are not really in agreement. Although GDI was revised up recently, a little bit closer to GDP. So if we're right, inflation will continue to surprise on the low side of expectations. And what's nice about what has happened with Fed policy is, whereas they used to think employment increases were negative in terms of their mandate to get inflation under control. Now they are not thinking that as much. And that's a good sign, because guess what? Over the last 40 years, real growth and employment has been associated with falling inflation. Real growth is associated with productivity gains, which are a significant antidote to inflation. And we think that's one of the things that's been going on. Nonetheless, that disconnect, the Fed disconnecting real from inflation, is very important and bullish, I think. Here's the real Fed funds rate. What is this? This is Fed funds, the Fed funds rate minus the CPI. So it's at about 5.5%. The CPI is at roughly 3%. So you see here 2.5%. If we are right and inflation goes negative and the Fed funds rate were not to change, it would head up to that 7.5%, 8% that we saw last in the early 80s. Now, again, nothing happens in a straight line. We think some of the prices, like gasoline prices, are going to throw us off a bit on inflation. It may be that we hang around this 3%, 3 to 3.5% for longer because of that. But if growth is correct, and if our outlook about pricing power, corporate pricing power is correct, then we think it will resolve to the downside and will not continue up. What's interesting in the rest of the world led us into higher interest rates. This is typically true because emerging markets are at greater risk of inflation, and so they acted sooner than we did. Many of them in 2021. You can see Colombia was one of the first to lift interest rates. Others here, Brazil, Mexico, Hungary, Czech Republic. The reason we put in Switzerland, it was not early to raise interest rates. It was more like the Fed. But you can see it is the first developed market to cut interest rates here. And one of the reasons that it's cutting rates is its currency was appreciating, threatening deflation in that country. The reason the emerging markets are cutting rates now is because they are experiencing some pain. The dollar has been going up, and many of them have dollar-denominated debt, and so it's very difficult to service that debt as their currencies have been depreciating. I think what they're doing here is trying to stimulate their economies back into a unit growth dynamic. Because again, maybe they understand better than a lot of policymakers that if you get unit growth up, you'll get productivity growth up and inflation down. They're in a bit of a difficult situation, I must say, because, and we'll go through this in a minute, there are now devaluations in currencies. They're being forced. They're being forced because of the strong dollar is forcing them into devaluations that they don't want. Devaluations are inflationary, so it's a vicious cycle. And they're now cutting interest rates. So it's an interesting dynamic. There's not enough people in the United States pay attention to what's going on in the rest of the world, especially the emerging markets. And I'll tell you another thing that I think is going on. There is a new money, a new currency out there that people in emerging markets, if they have a digital wallet and an internet connection, they can buy Bitcoin, so they can protect themselves against currency devaluations. And I think more of this is going on than a lot of these countries are willing to admit or even recognize.
Given the uncertainty of what could happen over the weekend and into next week, the markets are jittery for sure. But on the bright side, companies are starting to report earnings against analysts' predictions that were previously pared way back. Why is this important? Well, it's important because the lowered analyst expectations should be way easier to beat. With all that, let's take a look at the wall of worry and what the charts and metrics might be telling us. So as we've already covered, you can see that the markets finished negative for the week, but it was an extremely choppy week with 3 up days and 2 down days. What about over the past month? Well, over the past month, really kind of sideways to down, not really great looking. If we look at year to date, you can see how things are starting to falter here. We had a very nice rally up until about this point, and now, since then, we've been moving lower. Over the past year, we still have very healthy gains here, but I'm concerned about this topping behavior I'm seeing here. And what about the bottom dynamics? Well, if we take a look at the bottom dynamics, you can see that it's been really wonky. We've had a bottom confirmation attempt back here, but you can see that the confidence was really low. So no bottom confirmation. Now the bottom forming indicator has been moving steadily higher. And again, the confidence is falling. If the confidence goes higher and the markets continue to move lower and this bottom forming indicator stays up here or goes higher, then we have a bottom forming indication. But we don't have that yet. Now I'm going to go out on a limb, but based on what I see here, bottom forming indicator moving higher, equities falling, but the confidence level is falling. I would say we're likely to go higher in the next few days or next week. Let's take a look at the sort of trends here. So if you look at the beginning of this, and if you go back before this, there was a fairly nice uptrend here. And then it softened, as I've reported in previous videos. And now what's happening? Well, if we look at it over more recent history, it's kind of going sideways. And then if we look at it recently, it's starting to decline. Now, that doesn't mean we're going to go lower necessarily, but I don't like the direction, and I'm sure you don't either. Let's take a look at risk versus opportunity. Now, risk versus opportunity doesn't look great. You can see that risk acceleration is still above 60. I don't like it when it's up here, but you can see that it's been on kind of this general decline here. Now, risk level is really a laggy indicator, so I don't like the way it's pointing, but it's not at a level where I would be concerned. I get concerned when this gets up above 70 or 80. And the fact that this is declining, if this continues to decline, this will eventually turn around. Now, the opportunity level is also a lagging indicator, much like the risk level, and you can see that it's been declining as this has been climbing higher. What about equity versus safety? Well, equity versus safety, well, let's go right to the overlays because that really makes it easier to see. Again, don't like the fact that cash is sitting up here at number 2. Now, what's really confusing here is that small caps and the NASDAQ 100 have switched places. So this looks healthy for the NASDAQ, not healthy for small caps. But what I also don't like is that the S&P 500 and the Dow have also moved lower. So the only thing moving higher here is the NASDAQ 100. Now, that could be viewed as a good signal, right? NASDAQ 100 stocks or as an index is riskier and more volatile than the S&P 500 and the Dow. I'd really like to see both the NASDAQ and small caps moving higher, but that's not the case here. And if we look at safe haven assets, you can see what happened way back here. Gold and long duration treasuries shot up. These are safe haven assets. But then since then, gold has stayed high and the treasuries have just tanked. So we have an unhealthy treasury market, but gold is staying up here. Now, do the markets think that inflation is going to be a persistent issue? That's basically what this is telling me. I don't agree with that scenario, but that's what the markets seem to be thinking right now. And of course, the geopolitical risk all over the world, Ukraine, Israel, all of the stuff that's going on in the world scares people. So that's another support for gold. But when we get to the buying and selling pressure for gold, you'll see that it did something interesting on Friday. So what about the buying and selling pressure for equities, though? Well, you can see what we're facing here. Everything's down. The Dow dropped, selling pressure increasing. S&P's kind of pulled back. And now the selling pressure has pulled back, and the buying pressure is actually above the selling pressure. So maybe that's a good sign. For the NASDAQ 100, sideways to down. The buying pressure, it's hard to see here. The solid gray line is just a tick above the selling pressure, the solid orange line. And for ARK, it hasn't been a good picture. You can see the declines here, selling pressure well above the buying pressure. And what about small caps? Well, similar to ARK, falling price, rising selling pressure. What about sector rankings? Well, sector rankings, these are very laggy in terms of what they indicate. And you can see this looks fairly healthy here, except the consumer staples were ahead of consumer discretionary. And then if we move to this week, you can see that gold moved up, but we still have Bitcoin and technology way up here. And consumer staples fell a little bit, and consumer discretionary moved up. And now you've got cash and treasuries way down here. So this looks really great. Now remember, this is a longer term view. So this is going to take a longer time to turn around if the markets continue to degrade. If they don't, then this was telling us the right picture here. But let's take a look at sector rank acceleration. So this tends to move more quickly. And you can see that while we have cash down here, we have 20-year treasuries and gold way up here. This is that flight to safety you saw several weeks ago. And you can see that we've got energy, no surprise there. Industrials and materials up here. Consumer staples are way down here, which is kind of a surprise. And consumer discretionary was up here. So where are we this week? Well, this week, treasuries have pulled back, no surprise. Cash has moved up a tick. That's concerning. But consumer discretionary has moved up here, and gold has moved up. So a very, just like we've seen over the last several weeks, a very mixed, a little bit confusing picture here. And what about Treasuries? Well, if we take a look at Treasuries, you can see we had a rally attempt here on Monday and Tuesday, just like equities. Then on Wednesday, Treasuries pulled back. On Thursday, they dropped but then rallied. And then on Friday, they pulled back again. So just like equities, very wonky looking. And this is concerning to me because this is kind of how things looked back in 2022 when everything was going down and nothing was going up except energy. That's not a good look. What about over the last month? Well, very unhealthy looking Treasury market. And if we look at year to date, again, a very unhealthy looking Treasury market. In fact, these are at bargain levels right now. And if we go back over 1 year, you can see how we had a very nice rally when everyone thought there would be 6 or 7 interest rate cuts in 2024. When that story went away, you can see that people ran away from Treasuries. I think long term, this will turn out to be a mistake, that these are really a bargain at these levels. Remember, these carry much less risk than equities, and you've got longest duration Treasuries down 20%. So just to get back to zero, these have to go up just to get back to even, probably 25%, let's call it. So that's a heck of a gain for a fairly safe asset class. And how does that show up in the buying and selling pressure? Well, you can see what we've had here. In the short duration Treasuries, we had a nice rally here, and then it's been very sloppy to down. And you can see that while the selling pressure was above the buying pressure, the solid gray line, they just crossed recently. And you can see the overall trend in the selling pressure is falling as the price is falling. So that's a divergence. And the divergence really comes here. The buying pressure is increasing as the price is falling. So hopefully that bodes well for short duration Treasuries. Now here, we've had a declining price in intermediates, but the selling pressure has been increasing. So that's not a divergent look. Although you could argue that more recently the buying pressure has been increasing here. But if you go back further, it definitely has not been increasing. I know that was confusing. Now, what about intermediate to long duration Treasuries? Well, again, falling price and the selling pressure well above the buying pressure. Long duration Treasuries, 20 years, falling price, selling pressure well above the buying pressure and increasing. Not a good look. And what about that inverted yield curve? Well, you can see we are a long way from becoming uninverted. In fact, we're 37 basis points away from that. Now, that's a little bit of an improvement from last week when it was 38 basis points. But there are two ways for this yield curve to become uninverted. The best way is for the Fed to start lowering rates because they control down here at the short end. Now, if they lower rates, that will bring these data points down here, right? And then the yield curve becomes uninverted. Why? Because at the long end, the rates would be higher than something, let's say, down here. So that's an uninverted yield curve. So that's a healthy way for this to happen. The unhealthy way is if the rates at the long end continue to move higher and exceed these very, very high short-term rates. And what's the Fed rate monitoring tool telling us? Well, this is basically a voting mechanism. It's what the markets are telling us the markets think about what the Fed's going to do. And you can see there's almost no chance in May that they will lower rates. And if we go to June, there's still very little chance here that they will lower rates. We get out to July, it becomes almost a 50-50 proposition. Actually, it's tilted more toward the Fed lowering rates by July. And September, it becomes much more likely that they will have lowered rates. I feel like I'm afraid. And what about gold? Well, here's what I was talking about. So gold has just been on a tear. As you can see, it's been going up, kind of went sideways here, continued very strongly higher into Friday. And what happened Friday? Well, the selling pressure started shooting higher and the buying pressure collapsed and as the price dropped. Now, why would gold drop going into a weekend where there's threats of Iran or some of Iran's proxies attacking Israel? That kind of makes no sense. I'm not sure what to make of that. And what about Bitcoin? Well, Bitcoin, as you all know, had an extremely nice rally. In fact, it goes back way back before this. It rallied up to this point, and then it's been kind of consolidating sideways to slightly down. You can see that while it's been consolidating, going slightly sideways to down, that the buying pressure has been quietly increasing. Now, it clearly didn't increase on Friday, but the selling pressure over the same period has been quietly decreasing. This is somewhat of a divergence here, and this looks good for Bitcoin going forward. If there's one thing to take away from my market review this week and last week, it's that the equity and bond markets are still skittish and on edge. This is not a good situation. It says there's nowhere to hide. So my hope is that this logjam breaks at some point, and equities move higher and treasuries move higher. This is why I caution you to be an investor rather than a trader who tries to time the markets. Investments and investing aren't that complicated if you know how to allocate your portfolio without destroying your returns and getting little to no protection from downside risks. As an investor, you need to take the long view and allocate according to your risk tolerance rather than fretting about what's currently happening in the world or what everybody else is doing that you read about in the media with their portfolios. If you want to be a better investor, I discuss how to allocate your portfolios in 2 key videos linked in the pinned comments below, titled The Ideal Portfolio Using Just 2 ETFs or Mutual Funds, and The Ideal Portfolio Using Individual Equities. Again, link in the pinned comments. Until next week, I'm Calvin Rose, and thank you for watching Invest Smarter. That's all for now.
Stay up all night, gotta work now. Make up my mind and it turns around. Say that I'm fine till I burn out. Thinking this money sounded so nice. Ambush here in the strobe lights. Pay anything for the high price. This life feels like the sunny water. Wet my lips, but the sun is stronger. Pour it out, if I'm being honest. It's just not everything you promised. Running down, drying out, what did you say? What did you say when I told you? Maybe this wrist wasn't gold proof. Packing my bags like it's all true. Hard to make friends when I'm focused on all these bars that I'm holding. I like the cold, but it's lonely, yeah. This life feels like the sunny water. Wet my lips, but the sun is stronger. Throw it all away, we could find that time to block out all the bells now and make it right. No, wait, gotta take what's mine, gotta bleach my hair, try my pain.